See my screen now. Great. They're going to cover 6 topics. It'll be a whistle stop on each of these. And what we'll do is, if you have a question in relation to any of them, feel free to kind of raise your hand or just ask me, unmute yourself and say, look, can I ask a question about that if it's something specific? If you'd rather, as Emma said, pop it in the chat, we'll get it to there. Or if you want to wait till the end or have a conversation about something that's specific to your circumstances, then I'm happy to hang on at the end as well to answer any of your questions that directly relate to something maybe that you're dealing with at the moment. And I suppose for me, when I think about financial well-being for people, money is one of the things that keeps us awake at night. I mean, that's the reality of it. If it's a credit card bill, or do I have enough money to pay these bills? These are the kind of things that can worry people. And if you think about your mental well-being and your physical well-being, these are all things that are talked about widely, but we don't talk so much about that financial well-being. But yet your financial well-being could be the thing that is having the impact on things like your physical and your mental health as well. So really important to get some information and start to feel a little bit in control. And that's kind of the benefit of what today is, the starting point for you. I mean, it's a bit like when we talk about going to the gym, eating healthy and stuff. We know we should do it, but it doesn't always follow that we do. So sometimes we need a bit of a reminder. We know it's going to help us feel better, it's going to help us be healthier, but we don't always do it. So a bit like that, we know that if we take control of our spending, you know, understand where our finances are at and have plans, then that's going to help us feel better about it, but it doesn't always follow that we do it. So today is about getting you some top tools and tips that will help you. The way I would describe it is really to see if we can maybe help to save you money somewhere along the way so that you can put that money to better use, to perhaps make your money work better and harder for you so that you're getting more benefit from it. And then things like protecting what's important for you and making those plans. So today's session will talk about sorting out your money, borrowing money, saving and investing, dealing with debt, insurance, and then we'll talk about planning for later life. So we think about the sorting out your money, and this is where we talk about steps to success. So you'll have received a handbook by email, I think, Emma, or when you signed up for this, and that will help you even after today, if you take that. If you have it to hand, fantastic. If you don't, it's not necessary. Just make some notes so that you can point back to it as you need to. But I suppose if we think about spending diary, and it's probably better for me now that I'm not in the office, but when I used to be based in city centre, up until I started working from home 12 months ago, I could go to the bank machine in our building and take out a 50 or 100 euros. And by the time I got home that day, it would be gone. And I'm scratching my head thinking, I'm pretty sure I went to the bank machine today. Does anybody else ever have that experience? You think, where is that? Like, where did it go? Because I went for the coffee, insomnia or whatever. And throughout the course of the day, it just kept kind of dwindling away. And then I'm asking the question, did I even take it out? So this is where completing a spending diary is really going to help you. And I think for me, the last 12 months, it's helped me because everything's contactless. So I know when I use it, I get a message on my phone saying you've spent some money in wherever. So I think this is really, really important, knowing what we're spending our money on so that we can actually make some plans and that we recognize maybe where some of that spending is adding up to, if you like, because sometimes it's the small €2, €5 on your lunch 5 days a week, for example, is €1,300 a year. That could be holiday, car insurance, something else. £250 on a coffee 5 days a week. 650 quid. What would you do with that? So these are some of the questions, I suppose, if you ask yourself, and that's where we think about what you're spending your money on and complete a spending diary, because that's really going to help you to understand maybe where there could be some opportunities for you to save some money, and to kind of think about what you would do with that money if you had it to spare. The next step is then to get into your income and expense check. This one's really, really important, because if your expenses are greater than your income, when you start to do your spending diary and you realize that, you know, here's what I'm spending my money on, this is where it's going, then you compare that with your income and expenses check, and you'll get some templates and tools in that handbook that you've been sent. So you don't have to start one for yourself. The template's there, you just need to fill in the amounts. So when you start to do that, if your expenses on a monthly basis are very, very close to or above what your income is, then you're going to have a problem. And that is something that will only kind of grow if you don't address it. So it's a really good way to help you to understand, am I in good health or on good solid financial foundations? It's because you really need to think about what to do in situations where your income isn't covering your expenses. And we'll give you some more tips about that as we go through today. Then we're talking about having a money goal. And I suppose having a money goal, it's like anything else. I mean, you as athletes will know if you have a goal and you write it down, you're more likely to achieve it and you're going to work towards it. And so goal setting is something that you're very, very familiar with. So this is something that you should really be successful at. I've no doubt that if you started to take these particular steps and then you start to set yourself a goal, then you should really be able to follow through on that and to achieve that goal. And it could be for anything. It could be to go to the next World Cup. It could be for around the world cruise. It could be to get the deposit for a house. Whatever your money goal is, having a goal and having something to work towards is really, really powerful. And you'll find some examples in your handbook as well on that. I think it's about page 28 to 31 on that. If you want to maybe take a minute even just to write down what some of your money goals might be, just so that they're in the back of your mind for as we go through today's session. So if you want to maybe write down for yourself, we won't ask you to share it, but just for yourself, what might some of my money goals be after today when I've left this session and I'm thinking about all the tips that I've got. So now you have a solid foundation to make a plan and to plan ahead, because you've got your spending diary, so you know what's been going on in your spending. You've done the income and expense check, so you know what the health of your finance and your financial situation is like, and you've got a goal, you know what you're working towards. And this is when you can start to plan ahead and make a budget. So you can now start budgeting your plans in terms of setting yourself up for success, if you like, in terms of achieving that goal, working towards that house or whatever that might be. And we've actually given you a pull-out budget planner as well in that handbook that you have there. So if you pull that one out, that's a really good thing to help you. What I would also say is if you have a family, involve them in the process. Don't do this for yourself in the back room, worrying about the finances and trying to do this, because it can be really, really helpful in terms of kind of the family situation and communication for people to understand that we have a goal for a holiday next year. As a family, we want to go to Disneyland. So that when you're having conversations throughout the year and you might have to say no to certain things because you're on a budget or you're trying to manage your expenses, and that having involved people in that conversation at the beginning, it tends to cushion the blow a little bit. You can say, actually, do you remember we talked about the family holiday in Disneyland? That's why we're not going to do X this weekend. So don't do it but on your own or by yourself. If you have a family, involve them, because it's proven to be that people have enjoyed that. It's actually benefited people, and it's helped to take some of the pressure, the mental pressure and the stress off when we do that. So think about that as you're working through your planning and your budgets, and it can be really beneficial. I mean, I do through my own day-to-day work, we're putting a huge push on financial capability for children, because even the awareness for children of saving and understanding what it means to save a little bit, even if it was 50 cents a week, it creates habits for those people in later life that they really, really benefit for in terms of financial capability and financial inclusion and their ability to be successful at that as they get older, because we do see that that's one of the things that really holds people back at the moment. So that's why it's really, really important, not just for you, but for any younger people in your house, that they understand what some of this stuff is. So it's not even just beneficial to you, it's so beneficial for anybody in your household to be part of this process as you're doing it. So I'd really, really highly recommend that. And then I suppose keeping your finances under review, and that's so, so important, because your circumstances will change. As you're kind of saving more, you might be able to kind of put a little bit more away, or if maybe you have less income coming in or your circumstances have changed and maybe your income is down a little bit, then you're going to have to adjust things a little bit somewhere. And the fact that you've done your spending diary, for example, and you've realized, oh, I'm spending €600 a year on coffees. If I just cut out the coffees, I'll be able to offset that little bit of income deficit or something there. So because you have it all written down and ready, to look at, you can keep it under review really easily if and when something happens to change. So I think that's really, really important. So they're also thinking about some tips in terms of saving your money. And some really interesting stuff here. Shopping around, a lot of stuff renews automatically and really easy. I got stung with something, what was it recently? That I had signed up for a year, but it was an auto renewal that I forgot to switch off, and then boom, 60 quid. I was like, oh, I meant to switch that off. So set some reminders and things for yourself for anything that you sign up to. Make sure if you've put your card details in, that if it's an auto renewal, that you set a calendar appointment or something to switch that off. So make sure you do that. But shopping around for things like insurance and credit cards, utility bills, and availing of those discounts. Irish people are actually more loyal than a lot of European counterparts, and we tend to stay with a provider. So if you sign up for a mobile phone with a certain provider, we tend to stick with that. You sign up to a bank account, you probably opened a children's account in a bank when you were a child, and that's the bank you've been with ever since. And we tend to we're stickers like that. Whereas if you go to some other European countries, they'll switch their mobile phone provider at the drop of a hat for a deal or an offer. Similarly with their bills and utilities and stuff, we tend not to do that. So be more proactive about that, because there are offers out there. I read an article, it was years ago now, saying people are more likely to change their life partner, so husband, wife, or whomever, than they are to change their bank account, because the perceived inconvenience of changing your bank account was somehow greater than the perceived inconvenience of changing your life partner. Now, I'm not sure about the science behind that, but actually there is a huge reluctance for people to change, reluctance to change bank accounts because of the perception, when actually it's a lot simpler these days. There's some switcher stuff in place, and the banks have to make it simple for you. So don't be afraid to sit down and have a look at some of those things and save yourself some money. If I put out a tweet and said, who would like to earn 300 quid on Friday morning for an hour of your time? I need you between 10 and 11 to look up some web pages. I think I'd be inundated with people saying, yeah, I'll do that for 300 quid. But if you spent an hour of your own time on Friday morning looking through your expenditure, your insurance, your credit card, your bank accounts, you would easily find those savings somewhere, and more, probably 500. The more that you looked at, the more you'll find if you went with your car, your house insurance, and all of those other things. But yet if somebody offered you that, you'd be happy to do it. We tend to be reluctant to sit down and do it ourselves, because we're like, oh yeah, that seems like a lot of hassle. So definitely so many things to be, so many savings that are there. The unused subscriptions, asking for discounts. I have a friend who's really good at that. She never pays full price for anything. I'm a bit more so when I have to do that. But if you don't ask, you don't get. So by all means, ask and you might get that. Tax refunds and reliefs and entitlements is an interesting one, because these are some of the most underclaimed of, I suppose, revenue allowances and things, are things like your medical expenses. So you've entitlement to claim back some of your medical expenses and things. So I tend to go to the same pharmacy if we need anything. And that way, at the end of the year, my pharmacy will give me a printout of everything that I've spent there. Similarly with my doctor, and a statement. Now, there's a little bit of an excess on it. It could be 200 and odd quid or something. But if you, again, have a family and you've got doctor's visits and prescriptions and all of these other things, if that adds up to €1,000 over the whole year for a family, and the excess is 200, then you're going to get tax relief on the balance of the 800. So you'll get tax back. What's involved? Filling out a form. Sitting down, spending 20 minutes or half an hour of your day and filling out a form and returning it to the revenue for a few hundred quid. So these are some of the simple ways that you can save money. And if you did all of that, I mean, you would have your family holiday in Disneyland sorted for next year. So there's an action for now. Get on it, block some time out with your next insomnia coffee to start looking at some of these. And you can actually go back a couple of years on the tax reliefs and refunds. Now, if you go onto the website, it'll give you the accurate, I don't know how many years you can go back, but you could do it for the last couple of years, and you'll certainly have some savings in there. So definitely think about those ones. This one here, I see firsthand all the time, watching out for scams. Only this week, there was so the the financial services that I work for, it's a big UK organisation, so it's like 50,000 staff around the world or whatever, primarily in the UK. And there was a policeman in the UK who was scammed, and through some really kind of sophisticated fraudsters, and yet he couldn't believe that he had actually been scammed, when he was the one who investigates some stuff like this, when people, you know, do get scammed, and it was just so real that he couldn't believe it. So thinking about anything that seems too good to be true, then of course it is. There's just no such thing as free money. It doesn't work like that. So you'll find things like fake ads, people advertising, I don't know, machinery, cars and stuff. You send the money, there's no car. Phone scams and the premium WhatsApp numbers and stuff. You've probably been receiving phone calls from Tunisia and international places like that. Don't answer them. Some people are so curious. Like, I have a friend who's really curious and they want to answer. I'm like, don't answer the phone. Like, just don't answer it, because you know that it's a scam. Unless you know somebody who lives in Tunisia, then there's no reason for that. So be very, very wary. Don't respond to anything on WhatsApp that seems strange or is out of the normal course for you. Phishing for bank details. This comes through an awful lot. You'll get on emails and things. You get an email that looks like perhaps something might be relevant to you. So, for example, if you were on holidays last year in Australia, you might get an email with the title, "Your tax bill from Australia visit," or something. And you're like, what? I owe tax for that holiday or whatever, or for that 6 months away. And the minute that you click on that and open it, then you're potentially exposing your device or your computer to a virus, which is kind of the stuff that we see in financial services bit. We've had, companies where the accountant or the accounts payable person has opened up a link on the computer, and then it starts to read. It's like a little infection that goes into your system. And the minute you open up your bank account website on that computer, so you mightn't be in your bank details, you get an email today and you open it up and you go, oh, that's a scam or that's rubbish, and you delete it. But the fact that you clicked on the attachment that was in there, it might have been an Excel spreadsheet or a link to a site or something. When you've clicked on that, that's the infected source. That goes in and sits in your device. And what happens then is it waits. It waits for the trigger. And the trigger is you log on to a bank account detail website. So it could be your Bank of Ireland, your permanent TSB. It doesn't matter what bank account it is. It's a bank website. It recognizes it and it starts to copy your keystrokes. And now it has your account details. It could have your PIN numbers, because it's taking information and it's feeding it to another source. And then you'll start to see money being withdrawn from the account, and you're thinking, how did this happen? So there's a couple of things. It can happen through an infected source, or it can happen then you might get a phone call to say, hi, it's Paula here from the bank. We've noticed some unusual transactions on your account. Can you please give me the first and last digit of your PIN number? Because they've only managed to get a certain amount of information, so they're ringing you now to get the others. It can sound so convincing and you might fall for it. So don't fall for stuff like that. The bank will never, ever, ever phone you and ask you for a PIN number or a password. They don't need to. So anyone who does, no matter how convincing they sound, it's fake. They will never, ever ask you for anything from your PIN number or your password. And this is where people are getting caught. Because if you give out your PIN number and your password, you've given the information to the fraudster. If you haven't, if you're defrauded in the normal course of events through no fault of your own, then you're covered. Somebody steals your credit cards and stuff, you're covered. If you give people or give somebody access to your bank card or something else, then that's a different scenario. So just be really, really wary. Anything that seems too good to be true. If somebody tells you that you've won the Spanish lottery, all we need is your bank account details and we'll lodge the 500,000 in for you. It's fake. It's a scam. Don't do it. So these are getting really, really sophisticated. Other stuff we're starting to see now is romance scams, people meeting up online, thinking that this person is really in love with them and all they need to do is, you just need to send me the money for the plane ticket and I'll be there. It never comes true. Builders, you see a lot of fake work. Builders, your gutters need doing. Preying on older people. So if you have older people in your family and in your household, be very aware of any work that's going on and how things are happening for them. Just watch out for that one as well. So savings and investing, thinking about savings and investing from your own point of view and what it is that you want to save for and things like that. We're going to have a look at some comparisons and things to see, which I always find really interesting. Because I think sometimes when we look at something, we think, oh yeah, that sounds reasonable or that sounds affordable, when you realise that there could be a huge amount of savings and stuff in them. So think about saving and investing. You'll find this in the second section in the handbook that you've received today. It doesn't matter what you're saving for, but it's always good to know that your money is safe first and foremost, and that it's working best for you and making the most for you. And having regular saving will help you to kind of manage your money, cope with any unexpected emergencies and things. The boiler breaks down, need a new boiler, and all of a sudden you need $2,000 out of nowhere. So this is where having that emergency fund comes into place. It also helps you to borrow less, and it's always better. Like, borrowing is always more costly. You're paying the premium for that. So if you have savings, you're better off to use those first than to be borrowing for something if you can afford to save up for it, because it's always the cheaper option. It's also going to take away some of the stress as well. If you know that you have a little nest egg in case of emergencies, it will help for that. And it helps you to have a plan. We talked earlier in our first section just about having that plan, having a goal, and then setting yourself up for that. So I mentioned paying off your loans first if you want to start saving. There's a cost to having a big loan or a big credit card and something else, and there's no point in having a savings pot there not making you a whole heap of money if you're paying out a huge amount, 20% on credit card interest, for example. So really be aware of what your loans are, what do you have, and what are the priorities, if you like. So when I'm talking about savings, I'm talking about this regular savings, putting money into a deposit account where it's safe and secure, and making sure that we're kind of set up for success, that we're not doing anything that's kind of going to put your money at risk. So paying off your loans, really important. It's a more cost-effective way, is important. Thinking about the comparisons, if you like, for products and services. So always read the small print. You might see something with the savings account, and depending for how long you're going to put your money in for, you might get more return for your money. So if you put in a certain amount and you leave it for 10 years, the return might be greater than if you just put it on an instant access, that you want access to your money. But if you need instant access to your money, then it's important that you do that. So make sure that you're comparing like for like at that time when you're making those choices. Think about your money in terms of where you're putting it. So banks, credit unions and things, you have your deposit guarantee scheme there. So your money is safe and secure. Up to $100,000, if you manage to get to that savings amount for you as a customer per financial institution, your money is safe. So in the event that something happens to that bank or something else, your money is safe. Up to that amount, you are covered. And that's the deposit protection from that government scheme. When we talk about investing, though, that's a different product. Investing isn't always about guaranteeing a safe return for your money. So when I use the word capital, so the capital is the amount that you're putting in. That's your money. Always be aware, I suppose, and understand when you're comparing this, is my money safe? That's the simple way, not to use financial jargon and stuff. The simple way is my money safe? If I put in 500 into this account, it's safe in a savings account. If I put it into an investment product, for example, is it safe? It might not be. And that's where you need to understand the risk. So if you are not in a position to kind of gamble with that money, if you like, if you need an absolute guarantee return that your money is safe, the 500 I put in, I definitely want back, then sometimes investing options is not for you. So that's why if you're not really shrewd in terms of financial services and investing, and if you're not in the business of kind of risk then you're looking for something with a guaranteed or a capital guarantee, it should say on that. So that means that any of your savings that you put in are guaranteed. And that'll be around things like bonds, for example, or even things like shares and stuff. People might say, oh, this is a sure thing. Buy these shares, it's a sure thing, you're guaranteed. Actually, you're not, because stocks, shares and things can increase as well as decrease. And we've seen examples where people have been stung by that. So don't take advice, I suppose, from friends or family who are not qualified. If you go to a qualified person in a financial institution, these are regulated roles now. So they're obliged to give you the correct information. They're obliged to do a risk assessment on you, and they'll ask you those questions like, how are you averse to risk? Or what's your feelings about risk? In other words, can you afford to lose this money? And if the answer is no, then you're looking for a secure product. And for most people that I would come across, the answer is no. I'm not in the business of risking my capital. I want to just make the best of my money work for me. So I would say that's probably where the space where most of us should be in terms of that. Unless you have money to spare and into that kind of thing, then it's not really a place that you want to go. But I would say if you do invest in something outside the regulated financial services, if you like, then it's important for you to understand that risk. And getting advice, if you're looking to get advice from somebody on any products or services, or you want to understand more, just pop onto the central bank's website and they'll give you a list of authorised financial advisors, but also any of your financial institutions, your own bank, for example. Anyone who works there who is selling products or services is also regulated by the central bank. So they'll have to give you the appropriate information for your circumstances and being aware of that. So any investments that you were to take out through some of those institutions would be, you'd get a suitability statement is what we call it. So they ask you certain questions to help understand. And again, I think that's probably financial language and stuff. When we talk about suitability statement, it prevents, for example, me selling a 25-year bond to an 80-year-old lady with her life savings, because the chances of her seeing out the next 25 years and actually benefiting from that product aren't really in her favour. So it's that's what we mean by suitability statement. Is it suitable for the person's age and stage and all of that kind of thing? So that's what you can expect if you go to your reputable financial institution. Now, you'll have some examples, and you'll get some really good examples on the Consumer Protection website as well. If you want to have a look, there's some calculators in there that you can actually put in the amount that you want to save or that you want to borrow, and it will give you out the answers for that specific amount. But in this example here, a 5-year car loan of 10,000, interest rate of 9%, which is give or take, then if you pay an extra €100 a month, you'd save over €1,000 in interest, and your car loan would be paid off 2 years quicker. If you put that money into a savings account, you'd get €13 over the 2 years. So you can see the difference and why it's really important before we borrow money to think about, could I save up for it? Because in this case, there's over €1,000 in the difference, which could go towards your next new car and replacing that car. So just be aware of some of that stuff. There is a handy table, like I say, in your booklet. So have a look out for that. It looks at savings and options that are available for people. But I would say just be careful and be wary, kind of mindful of the risk involved in some of those on the small print. And don't take risk if you're not in the position to do so. Just stick with the stuff that you know is guaranteed for you and will keep you safe and secure. Okay, let's pop on to insurance. So this is where we talk about protecting your family and belongings. So for me, protecting what's important to you, and that's really, really important. Think about planning for what we can't avoid things going wrong. Things will happen. and you can't avoid, but you can plan for them. You can mitigate and set yourself up so that if and when something goes wrong, that you are in the best position that you could have been for those situations, if you like. So if we think about kind of what we should do when it comes to insurance, we're doing this. I always describe insurance as, you hope that this is the biggest waste of money you will ever have. Because the idea of having insurance, and whether that's for, you know, health insurance for if you got sick, income protection if you were unable to work and pay the bills, or life protection, God forbid, in the event of death, cars, home protection, then you hope that's the biggest waste of money that you're ever going to have. But my word, it's the biggest lifesaver in the event that you need it. So it's one of those that you kind of, it's a balancing act. You see it coming out every month. Why am I paying this 25 quid a month for this? Until something happens, like a fire in your house, or you're out of work sick. Like I've had a family member who's been out of work for the last 12 months because they got a heart condition that came through. Some very athletic, you know, really thought they were fit as a fiddle, early 30s, and then all of a sudden is unable to work because the risk of going back into work in the current environment was too great for that, even though, so only that they had an income protection, then that would have been really devastating for their family. 3 kids, he's the main earner, and you know that's going to have a big impact. Now when he saw that coming out every month, he almost cancelled it because the wife had actually said to me, I'm not sure if I said, where's your policy? Have a look. And she's like, oh, I think he cancelled that. And I was like, oh, we'll check your bank statements to see if it's still going out. It was, thankfully. But he had been looking at that months beforehand saying, why am I paying? It was €65 a month. And he was saying, why am I paying this out? This is the biggest waste of money. And then like that, something happens. And now he's getting 75% of his income paid back to him from this insurance policy that he had. So it's a good example of why you do hope it's the biggest waste of money. You don't want to be sick, you don't want to be out of work, or you don't want something to happen to your home or something else, but sometimes things go wrong. So that's why these things are really important. Not everybody can afford it, which is another thing. So again, we talked about being in the best financial position you can possibly be for your situation. That's where shopping around can come in. So shopping around for good deals is really, really important. There's always, even things like your car insurance, the difference, you know, one quote could be 1,200, the other quote's 300. And you're like, well, you know, how is that possible? Because it is. So always shop around, insure for the correct amount. So if you're insuring your car or your house or your contents, don't increase that because it will increase the price of your policy. Just because you value or you insure your car for 15,000 replacement value doesn't mean that if the car is written off, that's what you get. You'll get whatever the market value is on record at the insurance company for that car. So you could be overpaying on the basis that you've overestimated. And the same with things like your house insurance and your contents and your rebuild, for example. So just be aware of that you're paying the right amount for the right replacement value. Some insurance products are the law. You have to have insurance to put your car on the road. When you draw down a mortgage, there's an extra, you'll have to have a house insurance because there's an asset there that, God forbid, if something happened and the house burned down, then if it's not insured. So you'll be obliged to take out a home insurance policy. I would be, you know, don't let that lapse. Always keep your home insured because otherwise you would have a mortgage if something did happen, and you'd also have the debt of having to rebuild and stuff like that. But then there's the other ones that are the optional. So the health insurance, life insurance, and income protection. When we talk about the situation the example that I just gave, so that one was 65 a month and it was a good policy and it covered 75% of the income. You might only be able to afford €20 a month, but actually that might cover 25, 30, 40% of your income. So you don't need to protect 100% or 80% of your income. If even 20% of that was enough and it was guaranteed to kind of keep you ticking over, God forbid, if something happened, and if that was more affordable. So, you know, think about kind of the different degrees of what some of that affordability might be in terms of some of that optional what we call optional cover, and making sure that you have the right protection in place for you, your family, and your belongings. Anybody, any questions on insurance and some of those protection pieces? Borrowing money. Here's the, giving you the answer. All right, who has a credit card? Give us a wave. If you have a credit card, interest rate's probably around 20%. And if you're only paying the minimum payment of 20 a month and you had €1,000 running up on that credit card, and if you didn't see the answer before it flicked up, who would like to hazard a guess how long it would take to pay off 1,000?
I think I'd prefer not to guess because the answer might upset me.
10 years. If you were only paying off the minimum, you're not paying off the amount, if you like, of what you've borrowed. You're only ticking over the interest. And that's just ticking over the interest. So all it will do is continue. And it's going to cost, that 1,000 balance is going to cost you nearly 2,400 in interest, just because you're hitting it with 20. And I see that a lot when I talk to colleagues from the branches. They say, yeah, people coming in with credit cards, paying the minimum, paying the minimum. That's the kind of stuff that stresses people out, keeps people awake at night. So whether it's you or a family member or wife, partner, husband who has a credit card, sit down and have a chat about it and say, this is not going to go away. What you can do, for example, is look to maybe put that onto a small personal loan. And then you make your repayments every month, and the personal loan could be over 10 months, 12 months, 24 months, but then it's over. It gets paid down. On a credit card, it won't get paid down unless you're clearing the account, unless you're clearing a credit card every month. It's costing you money. It's always costing you money. Anything that you're buying on that is costing you more because you're only ticking over. So think about, if you've got a long-standing balance, then think about, what can I do maybe to change this and make that situation better? So when you're looking to borrow money, could you save up for it? We mentioned earlier that, it's always cheaper to save up because the money that you will get in interest on your savings will never match what you will pay in interest for borrowed money. So what kind of credit and provider suits your needs? Be wary of these, again, back to the scams and money lenders or unregulated people. Go to the credit union or your bank or your post office and understand what type of credit suits that particular situation. If it's a car loan, or if it, don't buy really expensive things on your credit card, for example, because the time that it will take you to pay off and the interest, it's going to hugely increase the cost of that item. So that's what we say when we mean the type of credit that suits the need. So don't buy a second-hand car on a credit card just because you've got a $5,000 limit. Doesn't mean that that's the right type of credit for that particular kind of purchase is what we mean. Even things like big family holidays, if you're going on if it's a special event and it's going to be a couple of thousand, that's not something for your credit card either. You can go to the bank and get a holiday loan. Funeral expenses, you can go to the bank and get a funeral loan. Again, these are cheaper options than people default to a credit card because they might think it's easier. Oh, I'll just put it on the credit card, I'll sort it out. But you could be paying that off, see here, 10 years later. So think about it. And usually these kind of things happen very, very quickly. On average, like a car loan in the bank, on average, the money could be in your account in 48 hours if you're an existing customer in that bank. So think about the type of credit that suits your needs. How long should you borrow for? So over how many years? We'll have a look at some calculations on that and you'll see where the difference is. And then can you afford the repayments? So there's no point in borrowing something if the repayments are, borrowing higher amounts if the repayments are going to leave you squeezed with no money and no flexibility at the end of the month. And then I mentioned credit reports earlier. So just be wary of your credit report and anything that is in it from the past. You might want to have a look. You can get that through the Irish Credit Bureau and just see, is there anything that I need to tidy up or have a look at there. Comparing loans, I really like some of these examples. So here we have a loan. Somebody borrowed 5,000. the option was, do you want that loan over 3 years or 5 years? So the interest rate was exactly the same, but by spreading it over 2 extra years, so by extending it out, it made the monthly repayment much more affordable, because I only have to pay 103 a month, whereas if I took it over 3 years, I have to pay 159. Now, that might seem, oh, this is handy, that'll give me a little bit of extra kind of pocket money every month or make it a bit more comfortable. But also the cost there's an extra cost of €500 by spreading that out over. Now, this is where the affordability, so what can you afford, which I mentioned on the last slide. The 103 might be all you can afford, which is, then this means that loan is the right option for you. But if you can afford the 159 and you just want to kind of make it a bit easier so that you have that extra 50 quid in your pocket every month, then think about the long-term cost of that, because that could be the 50 quid that, you know, the disappearing 50 that I mentioned at the beginning of the session when I take it out of the bank machine, if it's just 50 quid. So think about that. And here we have another one where we've got the 5. So if you look on the left-hand side, vertically down now, we've got 5,000, both of them over 3 years. But there's a difference in the interest rate here. So you see 9% and 11%, and that changes the cost. And that means it's €169 more because of the higher interest rate. So sometimes when you go in and you're comparing, when we talk about comparisons, and that you might see in one bank window, the APR is 9%, another bank 11%. So look out for those and check the cost when you're comparing the loans. Similarly, we have the one on the 5 years for 5,000 as well. And the cost here is nearly €800 more. And these are examples that you'll have in your, there's a website, on the website, there's a link there. You can actually fill in the amount. So if you're thinking about borrowing 20,000, you put in the 20,000. If you've got shopped around and you've 5 different prices or 3 different prices, put them in. It'll tell you how much it is, and that will tell you over the course of the number of years which is the cheapest and the best option. So do go to the Consumer Protection website and have a look and play around with that calculator. Now, this is the mortgage one. So this is where it can get really interesting. My slides are clicking. Okay, so 250 grand mortgage, 30-year term, shopping around for the best rate, and even switching your mortgage. If you've got an existing mortgage and you want to switch it for a better rate with another institution, then have a look at some of these repayment options and things and think about. So there's 20,000 in the difference here to be saved. The same amount borrowed, the same term, 30 years, but the APR, and it doesn't look much. When you see 3.7 and 3.3, you're thinking, you know, is it such a big deal? You know, I'm with this bank already. It's easier to go with them than fill out new forms or something. Well, actually, if somebody said to you, it's going to mean 20,000 in your pocket, what would you prefer? I know what I would be saying. So use the option, use the mortgage comparisons on the CCPC website as well, if that's what you're thinking about and you're looking at getting a mortgage, because 20,000 is a huge amount. Anything on mortgages? Any questions? No? Okay, we can jump in at the end. And then dealing with debt. So prioritizing your debt is really important. Priority, and you know, what's the priority and what's the secondary debt? This is where I say keep the lights on. If you're not paying ESB and if you're not paying your, you know, your utilities and you get switched off, then that's going to be a real problem for you. So really, if you find that your circumstances have changed and you're dealing with debt, then really important to go back to the planning and writing stuff down, doing your income and expense, and then do your debt, prioritize the list. Who do I owe money? Who do I need to pay every month? Which of these are absolutes and then which are nice to haves? Revise the budget. So that budget planner that you did earlier. For things like mortgages and that, always contact your bank first and foremost. If you get into difficulty or if your circumstances change and you find you're out of work for a period of time, contact your bank first and foremost, proactively, because they'll be really, really happy to engage with you. I suppose where you might find difficulties, if you leave it for 6 months and debt starts to pile up and there's been no contact, that can be a concern for people. So it's really important that you contact proactively. Keep a record of any conversations, renegotiating of payments. They might give you a payment break. They might reduce your repayments for a period of time and things like that. But make sure that if you do get a new plan, that you absolutely stick to the new plan, and pay the right amount on time and continue to engage. Or if you can't, that you get back onto them and say, I'm still continuing to struggle. There's people in every institution who are actually, that's their job. They're allocated this job to deal with people who need to reevaluate their loans or restructure their loans and things. So they have experts there to help you. So utilize those services, and then keep up to date and review your finances. And as things go back to normal, then you can go back maybe to your old repayments and get things back on track. Awalia is the place in terms of getting help and support for you. Then I would go to Awalia for any arrears support stuff as well. They're really, really helpful. Lots of tools, advisors there that can help with any, whether it's a small issue or a big issue, reach out and they'll certainly be there to support you. Now, retirement, and I know there was the pensions question, you know, getting to that stage where you're thinking about retirement and, you know, you have an income. What's your future income but going to be? Can I afford it? Can I afford to live in retirement based on a state pension and things? This is where your current income is made up of your salary, your wages, any overtime, any bonuses and things that you have. When you retire and you become retirement age, I don't mean retiring from sport and stuff like that, but actual retirement age and things, state pension will go so far. You might have an employer pension, you might have a private pension or PRSA, and then you've got your savings. So does all of that match what you're currently living off, if you like, in terms of the lifestyle that you've become accustomed to? And if there's a gap, if you like, between what you have been used to in terms of your income and what you will need to survive, then it's really important that you think about that proactively. So thinking about the calculator, and this is probably another good one for the question that came in earlier, have a look at the Pensions Authority calculator and their website for advisors and people that you can go to who give you good financial advice around pension programs and private pension savings accounts and things like that. You start out and you get an option to maybe pay into a pension. I remember my first job and my parents were like, oh God, you need to pay. And I was like, pension, God, like that's for old people. I don't need to think about that now. But the earlier that you pay in, the earlier you start investing in your own pension, the far better off that you're going to be in terms of setting yourself up for success for later life in terms of your retirement. So starting out, think about you'll get tax relief on it as well. So every €100 of your income, you're going to get tax relief on that as well. So you're actually getting more for your money. So it could be an option in terms of when we think about savings, and if you can afford it, ABCs, for example, in your company might be an option. That could be a very affordable way for you to kind of bump up a pension pot, particularly if you started late. So then thinking about if you're in a pension plan or you've had a plan, 10 years before your retirement is a good time to start thinking about and understanding, where's my money? How is it performing? How much am I going to get back from it? If you leave that too late until like a year before you retire, you might find that actually the pension cycle and the money in terms of where that has been invested could be on a downward cycle, because pensions, like all other financial things, they go through cycles of up and down and up and down. And what you really need to understand and act on is you want to act when the pot is up, if you like. So you want to be aware of where your money is, how it's performing, and what return you're going to get for that. And it's funny, we pay into a pension, particularly if it's in a work scheme. You wouldn't give anybody else your money every month and say, here's £100 for you, and would you put that away for me until I'm 65, and I'll give you a shout and then you can give it all back to me when I'm 65, and never speak to them again. Just hand over the money and then wait and hope for the best. You wouldn't do it. But yet when it comes to pensions, we're happy for that money to be taken out of our salary every month, and we don't ask questions about where it is, how well it's performing and things, because it's kind of pension jargon and pension speak, and that can be a bit uncomfortable for people. So you're like, well, maybe I'm sure it's fine. It's a pension. Of course, it's going to be okay. It's your money. You wouldn't give that money to anybody else and not ask any questions. So don't be afraid to ask questions of your pension provider, whether that's your employer, your HR department, or anyone else. But 10 years before your retirement is a very good time to start thinking about, where's my money at? What do I want to do now? Because that's when you can take action. You can think about taking your money out of the pot and putting it into a steady, low risk, no market volatility account, so that it stays at that level. And you can think about some of those actions 10 years before retirement, so that you do it at the right time in the pot, rather than waiting and then maybe finding yourself at a low point in terms of the cycle. And then at your retirement, that's when you need to think about, what do I need to do? What plans do I need to have in place? How much money do I need? How am I going to access this? And things like that. So being really aware that they're the three kind of stages, if you like, in terms of when you should be thinking about your pension. So when you start, even if it's something small. If you can afford it, put it in, because you'll get more for your money. You'll get your tax relief on it. 10 years before retirement, you need to have a good information around how your money is doing. And then at the retirement, in terms of taking your pot and enjoying it, enjoying your life after retirement. Because you'll spend probably 20 or more years in your retirement. So there's a lot of time to be spent there. So that's going to cost quite a few bob. So you need to make sure that you have yourself set up for success from that point.